Is SMCI supermicrocomputer finally a buy? We've covered the earnings report, so if you missed that, that will be in the top right corner. SMCI stock is down over 50% since its all-time highs earlier this year. It was down 20% after it's released their latest quarterly figures. Right now, maybe around $500 it might be a buy. Why am I saying this? Despite what I said in the earnings recap? Well, because one, I'm not talking about a short-term move, I'm talking about what might happen in the long run. I will still stand by what I said. It is a business that will never have high margins. So you have to take that into consideration. But if they can improve margins, then yes, I think at these prices, it could make sense. And I'll explain throughout this video, of course, why. If you enjoy this type of videos, hit all the buttons, like, subscribe, but especially the notification bell, because I do think that that's the most important button that you have to click so you don't miss future videos. And of course, if you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So as you can see, in the last month, SMCI stock is down close to 40%. Year to date, of course, stock is still doing quite well, still up 80% or so. At one point, it was up 317%. AI hype plus a huge business acceleration. Right now, it has a market cap of $30 billion and a forward PE of, well, let's call it 15 times. EV to sales in the next 12 months, 1.2 times. But if we look at what the analysts are expecting right now, those numbers are a bit updated. For fiscal year 2025, I mean, still below what the company said. Although it's a bit higher, it's still at $26.34 billion, which represents 76% growth year over year. As for EPS, we're sitting at $34.4. That's up close to 56% year over year. And then for the coming fiscal years, bottom line is growing faster than the top line. The top line will be growing between 17 to 20% respectively. So far, those numbers can get updated. And what's interesting to see here is that currently the average analyst price target still sits 75% higher than the price we're at today. The average sits at $905, and yes, after the earnings report, the average did come down from around $1,000 to now $905. So let's call it a 10% haircut. Now, if we look at some valuation metrics, it's still more expensive than its 5-year mean, but not by much, right? It's actually very, very close to its 5-year mean. Then you've got the price earnings to growth at 0.36, which, let's be honest, is extremely cheap. And even if you say, oh, but look at the other things, it's at the mean, if not a bit above. Yes, it's true, but the company today is still growing much faster than before. So yeah, I think there might be something here. And so let's go over a couple of things here. So Supermicro continues to experience record demand of new AI infrastructure, propelling fiscal 2024 revenue up 110% year over year to $14.9 billion, and non-GAAP earnings per share up 87% to $22.09. We are well positioned to become the largest IT infrastructure company, driven by our technology leadership, including rack scale, DLC liquid cooling, and business values of our new data center building block solutions. The investment in Malaysia and Silicon Valley expansions will further strengthen our supply chain, security, and economies of scale necessary for the growing AI revolution. As for what happened last quarter, this is a great summary by Brad Freeman, stock market nerd on X. I highly suggest you go follow him. So for the quarter, they roughly met revenue estimates. They missed on both GAAP EPS and EPS. As for guidance, annual guidance, a beat by 19.7%. Q1 revenue guidance beat by 19%, but they missed EPS guidance by 10 cents. But on the flip side, they did beat Q1 GAAP EPS guidance by 22 cents. Now the problem is, of course, as you can see right here, if you look at margins, it has come down 240 basis points the last 3 years. Year over year, it's down 580 basis points. Quarter over quarter, it's down 430 basis points. So that's basically the big issue here. Plus, they also announced a 10-to-1 stock split, which, to be honest, is just a way to trick retail into thinking, oh, it's now a buying opportunity. No, the stock split doesn't change anything for you. Now, as I said in the NVIDIA video, if you haven't watched that yet, it's going to be in the top right corner, but SMCI, Dell as well, they're all talking about liquid cooling. Why is that? Well, because for cooling, air is 17 times less effective in removing heat than liquid. So of course, all of their customers would love to get liquid cooling. The thing is, it's still early days, they're still supply constrained. Now, during the call, they did ask the CEO about the NVIDIA Blackwell platform. There are some rumors of some delays that's probably going to happen, how that will impact a company like SMCI. So the analyst asked here, has your guidance contemplated as we think about the December quarter? Do you believe that you'll be shipping the Blackwell platform solutions for revenue in the December quarter? Or should we think about the full year guide is a bit more weighted towards the back half of the fiscal year given some of these concerns around the timing of Blackwell availability? So the CEO said here, we are relatively very conservative. I understand Blackwell may postpone how much we don't know exactly because the new technology always can be pushed out. For Q4, December quarter, he says he guesses it will be very, very small. Engineering samples, small volume. So the real volume, he believes, will be in the March quarter of next year, and that's why they foresee only $26 to $30 billion, which again, beat the market's expectations. That means that once Blackwell is generally available, that would be a huge boost for SMCI. Another analyst here asked about the sequential decline, more specifically gross margin for 430 basis point sequential decline. How much was that the result of customer mix, which is the higher hyperscale customer mix versus the impact of ramping liquid cooling solutions? He then said something about losing about $800 million of revenue in the quarter because of non-availability of components. Is that all liquid cooling related, or was that related to other things like GPUs as well? To which he got two answers. By the way, reading transcripts, you think that these guys have never learned any English because the mistakes here are incredible. But anyways, he said it's pretty much liquid cooling, but as they move to July, August, they have much more liquid cooling components available right now. Second answer here with regards to the $800 million loss, says here it isn't a loss, it was pushed out into the next quarter. Yes, they were surprised by the amount of demand that they had in this market. And as they know, their manufacturing efficiency has been improving every day, and so they expect that to continue, and that's going to help gross margins going forward as they deploy liquid-cooled racks at scale. As for the deployment of the liquid cooling racks, is that expected to be linear, or is it more back-end loaded? The answer here is basically we support a handful of customers for liquid cooling, and most of them, once they try the liquid cooling, they will continue to deploy higher percentages with liquid cooling because the hardware acquisition cost is about the same, but they will save a lot of energy costs. So they believe this growth will be consistently growing. Liquid cooling for sure is necessary and is very helpful for the Blackwell solution, although Blackwell solution pushed out a little bit, but they will enable liquid cooling for H100 and H200 as well, and a lot of customers are interested in their H100 and H200 liquid cooling now. Oh, and by the way, when you move from cloud data center to an AI data center, it needs about 40% more power. So of course, all of those customers will want to get the solution that will save them a lot of energy costs. Continuing here on the DSC product, they say we exited the year with an acceleration in innovative DLC products, a large design win pipeline, and strong backlog, positioning us for continued growth in fiscal year 2025. We expect gross and operating margins to gradually increase in the year, driven by product and customer mix, manufacturing efficiencies for new DLC AI GPU clusters, and new platform introductions. As Charles discussed, shipments may continue to be constrained in the short term by supply chain bottlenecks for key new components for their advanced platforms. However, long-term gross margins will benefit from lower manufacturing costs as they scale up production in Malaysia and Taiwan, in addition to expansions in the Americas and Europe. We have a path to improve gross margins to the target range of 14% to 17% as we introduce innovative platforms based on multiple new technologies from our strategic partners and improve manufacturing efficiencies on our DLC solutions. Again, this is about the long-term target, remains to be seen when that will happen. Because right now, as we know, that sits at 11.3%. And so if we look at SMCI's graph here, of course, at the start of the year, huge jump, reaching over $1,000. Since then, the stock is down around 58%. Right now, on the daily, it is oversold. On the weekly, not yet. If we actually go to the weekly, we can see not yet oversold. Although we've seen 3 weeks in a row of red candles, RSI is still not oversold. And look at how overbought we were back here in February. We were overbought already when the stock was around $400 or so. So from $400 to over $1,000, we were overbought. So as you know, when you're overbought, that does not mean that suddenly you're going to see red candles. No, you can stay overbought for quite a while. And then yes, there is going to be a pullback. But at the end of the day, it's all about the business performance. And so for long-term investors, this might be an opportunity. Of course, lower can always go lower. That's why it's important to follow what the business does. If suddenly the market 3 months from now will see, oh, look at this, gross margin is already better than last quarter. That's great. Stock will probably jump because revenue-wise, that's not a problem. Revenue-wise, they beat it by 19%, right? So that's not an issue. The issue is how much of that flows to the bottom line. That's the thing with SMCI, with Dell. Those are not high margin businesses. So you have to take that in consideration. I think SMCI, just like Dell, maybe even HP, can be long-term winners. But if we're talking here about SMCI, yes, at a good price, it could be a good pick for those of you that hold SMCI or maybe want exposure to that market, because I do still think that it is early days, right? We've seen H200 still supply constraint as well. Blackwell hasn't even started yet. So there is still a lot of demand. There's still a long way to go. That's all I've got for you today. Do share your thoughts down in the comment section below. If you enjoy this type of videos, leave it a thumbs up, subscribe if not, and I'll see you all in the next one. Bye-bye.